If madness had a headquarter, it went have started with WeWork, kombucha on taps, yoga rooms, and a $47 billion dream built on shaky grounds. This is a story of a startup that soared on hype, crashed spectacularly, and is now clawing its way back. At its heart, a charismatic founder, a flawed business model, and a surprising second act. Stick around as we see how WeWork went from a cautionary tale to a test case for survival. Founded in 2010 by Adam Neumann and Miguel McKevy, WeWork's pitch was simple: lease office space, break it into desks, rent it to freelancers and startups. But Neumann didn't stop at desks. He sold a lifestyle, a we generation, a physical social network, blending work, community, and ambition. Investors loved it. In a post-2008 world hungry for innovation, WeWork looked like Airbnb of offices. Yet, beneath the buzz, the model had a flaw. Every new customer meant more real estate, more renovation, more fixed costs. Unlike tech giants like Facebook, whose goal didn't demand a new building. Newman's charisma was unmatched. He promised to elevate the world's consciousness and build a $1 trillion empire. SoftBank bought in. In 2017, Masayoshi Son invested $4.4 billion after a 12-minute pitch, pushing WeWork's valuation to $47 billion by 2019. But this wasn't about profit. It was about a narrative. SoftBank's Vision Fund needed bold bets, and WeWork became the star, even as its real estate-heavy model raises red flags. Critics later noted the confusion between capital-intensive growth and true scalability. WeWork wasn't a tech company. It was a real estate play with a tech veneer. No proprietary platform, no network effect, just long-term lease and short-term tenants. Here's the breakdown. WeWork leased buildings for 15 years at, say, $1.5 million annually, renovated them, subleased desks at $300 a month. You have 100 desks, that's $1.8 million in revenue, a $300 profit. But this renovation, staff, and utilities ate into their margin. And if tenants left, WeWork still owed the rent. This margin made it vulnerable. Unlike tech firms, where adding users is cheap, WeWork's growth required new properties and high costs. They overestimated demand, pegging their market at $3 trillion. Essentially, every desk job in their city, a widely optimistic bet. Locking into high-rent cities like New York and London at peak rates left them exposed. And when the pandemic hit, the demand for office space plummeted. WeWork's culture was a spectacle. Tequila shot at meetings, a frat house vibe with KPIs, and Neumann preaching a mix of spirituality and profit. He trademarked We, W-E, sold it back to WeWork for $5.9 million, and expanded into schools, We Go, and apartments, We Live, ventures that siphoned cash. Governance was a mess. Neumann leased his own property to WeWork, cashed out stock, and flew private jets while laying off staff. A loyalist-packed board offered no check, turning WeWork into his personal playground. The 2019 IPO filing was a turning point. The S1 exposed $1.9 billion in losses against $1.8 billion in revenue, self-dealing, and no governance. Investors bailed. The valuation crashed from $47 billion to under $10 billion, and the IPO was scrapped. Neumann was ousted, but left with a $1 billion SoftBank lifeline. By 2023, bankruptcy loomed with $19 billion in lease debts. As remote work reshaped the market, yet under new leadership, WeWork emerged from Chapter 11 in 2024, claiming profitability with a leaner focus. Post-bankruptcy, WeWork shifted gears. New CEO John Santora, appointed in 2024, cut unprofitable locations and targeted high-growth clients with longer leases. By June 2025, reports indicate positive EBITDA, That's earning before interest, taxes, depreciation, or amortization, with focus on hybrid workspace. Some see it as a leaner, healthier company, though pricing remains a debate. It's not the 47 billion unicorn anymore, but Survivor suggests lessons learned. Could WeWork succeed today? Maybe with changes. Focus on profitability in small markets, like their successful India model with local partnership. Could cut overheads. Shorter, flexible leases or revenue sharing with landlord could align risks with tenant turnover. A tech edge, say AI optimizing space or connecting tenants, could justify their tech claim and boost value. Stronger governance with independent oversight could prevent past excesses. A disciplined real estate play with a tech layer might thrive in today's flexible work world. WeWork's evolution offered 4 lessons. Cash flow trumps hype. Endless burning isn't sustainable. Charisma needs competence. Vision alone doesn't build a business. Know your core. WeWork was real estate, not tech. Be honest about it. Adopt or die. Flexible model and risk management are critical to shifting markets. What if I were to build WeWork replacement today? Here is how I will go about it, learning from their journey. Target niche markets. Start in mid-tier cities like Ibadan or Accra, where rent is lower. Partner with local landlords for revenue sharing to reduce fixed costs. 2. Flexible leases. Offer 6 to 12 months tenant lease. Align with landlord's terms to minimize risks. Use hybrid spaces with hot desking and private pods to adapt to 60% hybrid work trends. Number 3, tech integration. Develop an app using AI to predict demand, optimize spacing, and connect members for collaboration. Think Slack meets space management. This adds the value and justifies the tech label. Linear operations. Keep overhead low. Focus on Wi-Fi, basic amenities, community events. Avoid lavish specs. Aim for 20 to 30% profit margin from day one. 5. Governance and funding. Build a board with independent directors and seek angel investors or micro VC fund rather than over reliance on venture capital, ensuring sustainable growth. With an initial investment of $300,000 to $500,000 for a 5,000 foot space, you could break even in 18 to 24 months, scaling $1 million revenue in 3 years, adding locations. WeWork aimed to redefine work and stumbled. Now it's rewriting its story, and you could too. What's your take on building a co-working space? Share below and follow for more insights.